Hi, this is Michael O'Leary from Buy the Book Taxes, here for the next installment in our weekly video blog on tax resolution. What we're going to talk about today is a concept called net equity in assets, which is part of the calculation that the IRS uses in determining how much a taxpayer can repay their delinquent tax debts on a monthly basis. The IRS looks at three variables when determining how much a taxpayer can afford to repay. Net equity in assets, which we're going to look at today, future income, which we're going to talk about next week, and then our topic from last week, allowable living expenses, where the IRS employs statistics gathered by the Department of Labor to set local, regional, or national standards for living expenses. So today's topic is net equity in assets, which the question really is, if you owe the IRS money, what assets do you own that you can sell quickly to raise money to pay down your tax debts? This is considered a distressed or fire sale value of your assets. The expression the IRS uses is the quick sale ratio, which is equal to 80% of the fair market value of your assets. And then what you do is you subtract any loans or mortgages against these assets. In the case of a vehicle, you're allowed a $3,450 allowance, in addition to any loan you may have against the vehicle. And if you are withdrawing money from a tax-deferred retirement plan, like an IRA or a 401k, and you are under 59 and a half, you should employ the 70% figure instead of the 80% figure to take into account a 10% early withdrawal penalty that you will have. Okay, so the next slide I'm going to show is a chart where we take a fictional taxpayer, give him some assets, and then employ the quick sale ratio, factor in any loans or mortgages to try and determine what this taxpayer's net equity in assets would be that can be used to pay down tax debts. So here we go. Okay, here's a chart. He has a home, an investment account, a car, and a 401k. Quickly, we'll go through these. So his home has a fair market value of $425,000. 80% of that, the quick sale value, is $340,000. He has a $295,000 mortgage, so he has $45,000 of equity that could be used toward settling his IRS debts. He has an investment account, $175,000. 80% is $140,000. No loans. He's got $140,000 there of net equity that he can pay down his debts. He has a car that has a value of $28,000. Nice car. Quick sale value, 80%, less the $3,450 exemption. He has almost $19,000 of value in a vehicle to go toward his tax debts. And the last one is a 401k, $475,000. We employ the 70% quick sale value here, assuming he's under 59 and a half, and will have a penalty for early withdrawal. No loan or mortgage, so he's got $332,000 there. So his net equity in assets is $536,000 out of a gross value of assets of $1.1 million. So that would be the number, the $536,000 $450 that the IRS would calculate as available to go toward his tax debts. Hopefully, he owes a lot less than that. But if he owes more than that, that 536 is what would be used if he liquidated his assets. Okay, if you have problems, hopefully not quite that large, but if you have years of unfiled tax returns or years of unpaid taxes, and you're getting escalating collection letters from the IRS or threats of liens or levies, please take down the information on this slide and call me. I can help. See you next week.